Let's start with the accounting principles. We follow some accounting principles that is applied on each and every business. See, at times the theory really becomes boring, but I will try to make it interesting by putting in some examples. Please pay your attention here. The first accounting principle is accounting entity or business entity principle. Accounting entity or business entity principle. Now, what is this principle? Accounting entity or business entity principle. Business is treated as separate entity distinct from its owners. See, who is the owner of the business? One, this is the business, and this is the owner of the business, the proprietor of the business. If it is a firm, the owner is called as the proprietor. They are two separate entities. And see, that is why we term as business and owners are separate, because owner, what does owner brings in? Owner brings in capital to the business. And that is why we have a concept of drawing. That is why we have a concept of interest on capital, interest on drawing, because the owner is separate and the business is separate. If something is withdrawn, some goods are withdrawn from the business, then you reduce the capital. Why? Goods taken for personal use, or say if furniture is bought for owner's residence and cash is paid from the business fund, then what will you do? If you will treat it as drawing, because furniture is used in owner's residence and not for business. So we say that accounting entity or business entity principle, these are two separate entity. Now, our second principle, money measurement principle. Money measurement principle. What is money measurement? Very easy. Only the name only depicts money measurement. Transactions that can be recorded in terms of money are only recorded in the books of accounts. Say, I have a labor who is working very nicely for me and the other labor who can't work such nicely for me. Can I record the quality of labor in my books of accounts? No, I cannot record, because I cannot bring it up to the terms of money. So only the thing which can be monetarily measured has to be recorded. For example, say I have 100 tons of bag of cement. Huh? Is this all? If I record, is this all? No, I have to put it in money. 100 tons of bags of rupees so and so, rupees X. Until this rupees factor is missing, you cannot record it in your books of accounts, and that is what we call as your money measurement principle. Okay, it has to be assigned some value, then only you will record it. Anything which cannot be recorded in terms of money, no entry to be posted in a books of accounts. Now number 3, accounting period principle. See, you can get small objective type questions from these principles, that why this is so. Then you have to say that because of the money measurement principle we could not record a particular transaction in books of accounts or so and so. So just learn the concept, don't go on the words. Accounting period principle. See, life of the business is divided or broken into small parts. Why? Because everybody needs result year after year. The management, the bankers, investors, whosoever is interested in the business need to know the results of the business. So if at the end of the year we don't prepare a balance sheet and P&L, how will I get the results? So accounting period principle, for that you also know that we follow a financial year. The financial year is from 1st April, or it is also called as the accounting year, 1st April to 31st March. So this is my accounting period. I distribute all my expenses, all my incomes within this period only in my trading P&L. I write them in my trading, my P&L account and my balance sheet pertaining to a year, so that a true and fair picture has been shown. Not that I am preparing my accounts over 10 years, not before that. How will I get to know the results? So accounting period principle is finished. Now number 4, full disclosure principle. Full disclosure principle. What is full disclosure principle? Any significant information, word significant information is very important here. Important information. Any significant information relating to the economic affairs of an entity should be disclosed in the financial statements. Any material information, meaningful information, meaningful information has to be disclosed. What is a meaningful or a material information? That can change the decision of the users of that statement. There are so many people using it. So if there is some hidden information that can affect the decision of the user of those financial information, then it is wrong. You have to disclose all material and meaningful information to the users of such financial statements. That is called as full disclosure principle. Now the 5th, materiality principle. What is materiality principle? If a transaction is important to the extent that it can influence the decision of an informed user of accounts, record it. Record the material information. All material information should be recorded. The important thing here is record it. Here disclose it, here record it. Say for a temporary closure of a plant due to which a labor strike was taken or something like this, which is very material, record it and let the people know in the notes. Now 6th is prudence or conservatism principle. ever heard the word prudence? What is prudence? Prudence is what a man would do in common circumstances of having common sense. That is prudence. Okay. So what will I do? See, anything, whatever profit and loss account we are making, to decide whether there is profit or whether there is losses. And the prudent man, what a prudent man will do, he will provide for all the possible losses. See, what will he do? Provide for all possible losses. But will he start accounting anticipated profits? I have not still received any profit, or there is no, I cannot say that with surety I will receive some profit and I will start accounting for it. No. So do not anticipate a profit. Do not anticipate a profit. For losses, I should definitely provide. What is the motive of this? It is not to present a better picture than what it actually is. See, closing stock is valued at cost or net realizable value, whichever is lower. Say I have a closing stock. Closing stock, my cost is 12. My net realizable value is only 10. What is net realizable value? If I go into the market and if I try to sell it, I will not get 12, I will get only 10. So how should I record the closing stock? The closing stock should be recorded at 10 and not at 12. If I am recording it at 12, I am showing an untrue position of my profit and loss account. So the prudent, what a prudent man will do, he will provide for all the possible losses, but he will not anticipate for a profit. So this rule is followed just because of the prudence or conservatism principle, that cost or net realizable value, whichever is lower. Conservatism principle is the same. Provide for all anticipated expenses and losses. Example, provision for bad and doubtful debts. You make a provision for bad and doubtful debts and do not record for any anticipated revenues, So here you can say that for this principle applies for expenses and losses. See, prudence and conservatism, they apply for expenses and losses, and for revenue, income and gains. Okay, so what they say is provide for all anticipated expenses and losses, but do not record any anticipated revenue or gains. Okay, now the next principle, cost concept or historical cost principle. Don't try to remember these principles or mug up these principles. Just view the slide 3 or 4 times whenever you get time, and automatically it will fit in. It is somewhere being traced in your mind even right now. Cost concept or historical cost principle. Okay, and asset is recorded in the books at the price paid to acquire it minus depreciation and not at the market value. See, whenever I purchase a asset, say furniture, building, plant and machinery, land, whatever, all the expenses which I have incurred to get the asset, that is my cost, that is the price paid minus the depreciation. Is the value to record. Is the value to record in my books. Say for example, a building has to be recorded at cost less depreciation. It can happen that over, say, a business is running over 5 years and the cost less depreciation of the building is actually 1 lakh, but you all know that property market has jumped so much. So after 5 years, if I go to sell the building in the market, instead of 1 lakh, I am getting some 5 lakhs. I can sell it today in 5 lakhs, but then will I start recording the building at 5 lakhs in my books of accounts? No, that's not true. Only when I actually sell the building, I will record it as sales of my assets 5 lakhs, and the difference between will be my capital gain at that time. But even if the market value is higher, I will still record my assets as at assets cost less depreciation. This is an important point even when you prepare your final accounts. So just remember it: cost concept or historical concept principle. Historical cost principle. Due to this principle, I am recording my assets into the value of recording the assets in the books is the historical cost and not the market value. A very important point here. Now the next principle, matching concept or matching principle. You can get short objective type questions that why have you recorded it on cost price, or why have you not recorded on market price, due to which principle. Then you have to give an example and tell that due to this principle the accountant has done this, or the owner has not taken a right decision in doing this, something like this. Small questions will be asked. If your principle is clear, you can do it. Matching concept or matching principle. Now what is this principle? It is based on the accounting period. It is necessary to match revenue of a period with expense of that period rather than cash received or cash paid. Very, very important principle. See, I have the financial year of 12 months. Okay, rent paid should be part of the P&L. Even if you have paid for 13 months, that is 1 month is advance, recorded only for 12 months. When you do the final accounts, you will get to know that what we do is, see, I have my financial year from 1st April to 31st March. Okay, this is 12 months. Now I actually paid rent for 13 months. So with the help of adjustment entries, I will deduct the rent of 1 month here, which is paid additionally. I will deduct the rent of 1 month here, so that correct profit and loss is shown. Any expense relating to 12 months which forms one financial year only has to be recorded in the books of accounts. The next principle, dual aspect or duality principle. What is dual aspect? Your full accounts is based on dual aspect only. For every transaction, if there is a debit, see every transaction, if there is a debit, there has to be an equal and opposite credit. Accounts is as good as maths. If 2 plus 2 has to be 4 in maths, every debit of any x amount should have equal and opposite credit is the dual aspect. Why a dual aspect? A debit has a equal and opposite credit. This is the dual aspect on which full accounts is based. If you know the rules properly, and if you put the correct thing in the debit side and the correct thing in the credit side, the entry will not go wrong anywhere. It is just a game of debit and credit. So dual aspect, your full accounts is based on this. If a transaction has debit, there has to be an equal amount of credit in the transaction. Okay, 10th, revenue recognition concept. Recognize revenue when transaction is entered into and legal obligation is created. Revenue recognition and revenue receipts are two different things. For example, say sale of goods on credit on 1st January, amount is received on 27th January. So recognize sales on 1st January, as then and there is a binding contract which takes place between the buyer and the seller. See, you have to tell when you will recognize the revenue. And the other thing is recognize revenue when you are very sure, even in the contracts. See, many contracts are there when you will receive full money after the contract is over. But in higher standards you will have contract accounting, where you will find that so much work is done, say 1/3 work is done, recognize the revenue then and there. Then the 2/3 work is done, recognize the revenue then and there, and don't wait for the cash receipt. This is the revenue recognition concept. Now the 11th one, verifiable objective concept. Okay. All accounting transactions should be supported by documents. You should have a supporting document when you are recording a transaction in the books of account. Very important in practical life also. See, many of you will tend to become businessmen, and you should know, even in income tax, sale tax, a proof, a document, a supporting document is always required. Why I am doing this accounting entry into my books? Without a supporting document, say I am purchasing something and I am passing a entry without a purchase invoice, will they say that it's okay? No, there has to be a proof. So what are those proofs? Those proofs are cash memo, tax invoices, and bills. Proper cash memo, tax invoices and bills should be present, on the basis of which we do accounting. I should have a supporting document on the basis of which we do accounting. Tell me one thing, if there is nothing, if you don't maintain any invoices, say sales invoice, purchase invoice, if there is no invoice and the government wants that a chartered accountant should audit your records yearly, how will he audit without the supporting documents? He will check that these are the documents present, and so there is an entry in your tally. If you don't have supporting documents, he will also say, no, where are the supporting documents? Until and unless there are supporting documents, I will not verify your accounts, I will not put my signature on the accounts. So it is very important to have supporting documents. So it is said that whenever you purchase or you sell goods, you should keep a tax invoice with yourself. You should keep it in a proper file. Then only it is a base for the CA to audit your accounts. So it is the basis of accounting and auditing. So verifiable objective concept is the last concept. Just go through these concepts whenever you have time so that you will understand it better. I have tried to explain it with lot of examples so that whenever you get a small practical question based on it, you can get the answer correct.